We talk about fund flows. And speaking of fund flows, with rising yields and high valuations, foreign investors are making some big moves. They have sold $37 billion in the past 5 months. Let's bring in Somit to give us a breakdown of the FII selling patterns. Somit, over to you.
Well, yes, FII selling has been one of the major reasons when it comes to the fall in the Indian equity markets. In fact, to be precise, in the last 5 months, Indian benchmark, that is Nifty 50, has fallen nearly 20% on dollar terms, while the broader market, that is the Nifty mid cap and the Nifty small cap indices, have declined anywhere between 25 to 30%. And the major reason behind this is the sell-off coming in from the FIIs. Nearly $37 billion of Indian equities has been sold in the last 5 months by FIIs. Now, there are two reasons which could have led to this sell-off. Firstly, the non-India factors. Firstly, it could be the fact that the global investors might be shifting to debt from equity, given the fact that US yields had risen to 4.5%. The second reason is the shift from India to other emerging markets and developed markets, given the fact that there has been a lot of global uncertainties on the back of the tariffs that are expected to come in. Now, when it comes to India-specific factors, the first reason is high valuation coupled with lower earnings growth. Now, we started the financial year, that is FY25, with earnings growth expectation of around 13 to 15%. But right now, we are seeing an earnings growth that could be just 5% for FY25. So that is one of the major reasons. Apart from that is the lower capital expenditure or the slowdown in capital expenditure owing to general elections and various state elections. And then there is tight liquidity and lower credit growth, which also constrain the overall economic growth in the country. So what or who are these FIs that have been selling this data? Now, to come to that data, we have used the NSDL published category-wise foreign portfolio investors asset under management data. Now, we have compared the September month data with the January month data to see which of the FPI categories have seen the biggest drop in their asset under management. Now, why the asset under management would have reduced? It could have been because of the fall in the stock price and or because of the selling that we have been seen by the funds. Now, based on these factors, it is very safe to assume that if a certain categories certain FPI categories AUM has fallen much more than the overall FPI AUM, then it could be safe to assume that that FPI category must have been a seller in the Indian equity markets in the last 5 months. So in the last 5 months, if you look at the overall FPI AUM, that has come down by 13%, but the FPIs of these categories have fallen much more than that. So who are these categories? Firstly, if you look at it, it's the investment managers and investment advisors, which have seen a decline of nearly 37% and 32% in their AUM, which is way higher than the overall FPI AUM fall and the market fall. So these guys must be definitely the sellers in the Indian equity markets in the last 5 months. Then there is University Fund and AMC, which have seen a decline of nearly 25 to 28% in their AUM, followed by regulated entities, central banks and pension fund, which have seen a decline in their AUM of anywhere between 13 to 20%, and this is higher compared to the overall FPI AUM fall and the market fall. Now, if you look at which categories would be the buyers in this market, now these categories like insurance and reinsurance entity have seen a decline in their AUM of just 10%, which is way below than the market fall and the overall FPI AUM fall. So definitely they must be buyer in the Indian equity markets in the last 5 months. Then there is sovereign wealth fund, government-owned entities, endowments, which have seen a decline of just 8 to 9%, followed by LLPs, that is limited liability partnership, trust, banks and family offices, which have seen a decline in their AUM of just 4 to 7%. So these categories would be definitely a buyer in the Indian equity markets in the last 5 months.
Okay, well, on that note, let's get in Raghvendra Kedia, founder of Prosperity Advisors, who joins us on the show. Raghvendra, good morning and thanks for joining in. Why don't you tell us about what you are making of the fund flows, especially given the, the relatively stronger dollar against the rest of the currencies. How do you expect it to pan out, and what does it mean for fund flows here? Raghvendra, I think you're on mute.
Yeah, am I audible now?
Yes.
Okay. Good afternoon, Agam. Broadly, we feel we are taking few silver linings at current levels of Nifty, which is significantly beaten down. We believe that the US 10-year yields, which has a moved towards, which were eyeing levels of 5% yield, have come down to around 4.33. So there might be a slowdown in sell-off in equity and that money being shifted into the debt market. So that's one positivity we take. We believe that with this US-China war getting escalated, there might be a significant stimulus declaration from China in the weeks ahead in various tranches. So the metal sector in India and overall liquidity can get some boost in terms of this China stimulus prospects becoming very high. Third factor, on the domestic front, we believe that we are starting the Q1 earnings season on a very low base, where Q4 earnings season on a low base, where Q3 and Q2 have been pretty muted. So in terms of some pop in terms of the earnings and results could come. Fourth factor, again from the domestic positive side, is the massive efforts from Ministry of Finance and Reserve Bank of India in giving some kind of liquidity push, lowering compliance, making lenient regulations for the banking sector, where a leadership could come in from the private banks. So broadly, and icing on the cake could be some correction in Brent crude oil prices in the days ahead, considering OPEC's production increase announcement. So with oil prices coming down, stimulus from RBI, Ministry of Finance, China stimulus, US yields slightly coming down, these all factors collectively can bring some positivity to the Indian market at beaten down levels. And we believe that starting second half of March and April onwards, we could see some significant fresh buying in the equity markets for India, which could also comfort in terms of valuations and some kind of low ownership becoming moderate level ownership. So we are upbeat at current levels overall on the market.